Today, we're going to talk about net worth statements. Hopefully, you already have your notebooks because you've done your bell work already. If not, pause, grab your notebook, do your bell work, and come back to me. Welcome back. So let's go over these terms specifically for our PBMs, but they're also good to know if you want to start a business or be an entrepreneur in general. So first we have assets and liabilities. Now both are needed to run a business successfully. However, assets are going to add to your net worth. They're the positive, and then our liabilities, also known as debt, detracts from our net worth. Again, both are important, but of course we want to have more assets than liabilities. So for now, don't write down the 3 types that we have right here. We'll get to those in just a little bit. Just know that assets are items or systems that are tangible and that the person owns, and then liabilities are the debt that needs to be repaid. Now, we have our current assets and our non-current assets. So those are some of our 3 types. Current assets are going to be used or sold within 12 months. They go real fast. So this can be some cash on hand, anything in our checking and savings accounts, stocks, bonds, life insurance, and money that other people owe you. Those are assets. They just haven't paid them yet. Ideally, hopefully, it's within 12 months. Now we have our non-current assets. Now this is something that is more than a year. So we could have our infrastructure or depreciable inventory or land. We'll talk about land in just a little bit. But our non-current assets, they add value to our net worth and they last more than a year. Now we have our total assets. And as one can see, all you have to do is add your current assets and your non-current assets, and then they get our total assets. Simple math equation. Now we have our current and our non-current liabilities. Getting a pattern here, we have our current, which is to be paid within a year, 12 months. And then we have our non-current that isn't due at the end of the year. So let's go back to our non-currents. That can be accounts payable. That is a fancy accounting term known for you owe someone money and you have to pay them. Let's say you bought a whole bunch of tools and you don't have the money right now, but you will have the money in about 3 weeks. So the business that you bought the tools from says, hey, I'll give them to you because I know I trust you. Pay that back to me when you get paid in a month. So now you can use the tools, get paid, pay them back. And then, of course, 1-year loans. Now we have our non-current liabilities. That's our mortgages. Hopefully we're not paying off a $1,700,000 mortgage in a year. Maybe we will, maybe we won't. Multi-year loans and leases. And as before, our total liabilities are current and non-current liabilities added together. So in order to get our net worth, someone's net worth, we've heard that term before. It's also known as owner's equity, but the more popular term is net worth. You have your total assets minus your total liabilities, and that makes someone's net worth. Now, someone might want to know the debt to equity ratio. This we're not going to focus on too much. I just need you to know this formula right here, but it's used to measure a company's net worth compared to the liabilities that they have. So just because a company is looking good, they're whining and dining people, they've got all the new equipment, nice cool branded t-shirts, doesn't necessarily mean they're doing too hot. So our debt to equity ratio is how we figured that out. We're going to get our total liabilities and divide that by our net worth. That's going to give us a number, and we will figure out that number in a little bit. Now we have inventory. And inventory, this is the one that we're going to use the most in this PBM specifically, but we have stuff that if, let's say, we were to go under or the bank takes our farm away or what have you, there's some value within those inventories. We always keep an itemized list of things that depreciate and what the value was when we first bought them. We do that at school. We have barcodes on our codes, and that gives us a kind of sheet, a gigantic spreadsheet of how much CTE has and does not have. Our non-depreciable inventory, that is something that we're going to use up within a year. We see the common theme of if you're going to use it within a year, you don't need to put it in terms of tax purposes. If it's going to last you more than a year, you might need to put something on the books. So our non-depreciable stuff, that's feed supplies, that's, think about our classroom, scissors. We go through some scissors, we go through tape within a year. That is not something that I can tell the government, hey, I'm going to depreciate that. Now, let's say the Promethean board, that is going to depreciate because it gets out of date. As we see here, our technology advances. If anyone remembers smart boards, right? Ideally, it's going to last us more than a year. It already has, so I would put that as my depreciable inventory, and then all of my tape, supplies, paper, that is a non-depreciable asset or inventory. Now, here's the important thing we need to know. Land is not a depreciable asset. It is not a depreciable item because land is only going to increase in value. We cannot make more land. We can make more tape, we can make more scissors, we can buy more tools, we cannot make more land. Therefore, once you buy land, it is a great investment opportunity to have. I need to note that land will never depreciate.